China could be in trouble. What do you think is going to happen to your magic internet money if China is in trouble and if the second largest economy in the world collapses or runs into, let's say, increased economic woes? China currently not doing super well, and data is showing that the proverbial shit can hit the fan and just spray everywhere at any time. Now, you might be living 1,000 kilometers away or thousands of kilometers away from this problem, but China being the second biggest economy, when they sneeze, the rest of the world catches the flu, if you know what I'm talking about. So are you prepared for a potential fallout if that were to happen? Is there actually some bite to the bark of this story, though, or is everybody just freaking out about China like they do all the damn time? Well, let's settle the score in this video and find out. And by the way, at the end of the video, I'll also let you know my plans around any sort of China turmoil. Now, China's ascent to power began in 1978 when the government initiated a series of reforms under the leadership of Deng Xiaoping. The Communist Party implemented all kinds of changes that encouraged private enterprises, liberalized foreign trade and investment and all that kind of stuff. And the ride's been pretty good since then, right? They relaxed price controls. They started heavily investing in industrial production. And now industrial production in China is like going crazy. Seeing their trains? Their trains are awesome. Now, these reforms transformed China into a massive economic powerhouse. You've probably heard about that once or twice before, I imagine. Currently, second only to the United States. With a GDP of nearly $18 trillion, China accounts for approximately 18% of world GDP today. To put that into perspective for you, China's GDP is larger than the combined GDPs of Japan, Germany, India, and the UK, which are ranked 3rd to 6th respectively. It's that big, okay? So with that being said, anything good or bad that happens to the Chinese economy will affect everybody. It seems like, of course, this economic success story is starting to take a little bit of a wrong turn. Too much greed in the real estate markets, bit too much government control, all this kind of stuff. Why is China getting a bit derailed recently? Well, the COVID lockdowns didn't help, but we do have a problem with Chinese interest rates right now. They're falling. In fact, the 30-year interest rate has fallen to a lower level than the 30-year interest rate in Japan, which you don't want to be compared to Japan's economy because they had a 30 years of basically darkness in their markets. This chart here from the Kabezi letter shows that while Japan is slowly increasing rates, China is doing the exact opposite. Now, this is very significant since Japan has historically had very low interest rates due to long-standing monetary easing policy. By the way, monetary easing is just fancy talk for when central banks lower interest rates and deposit ratios in order to help make credit accessible. Now, this is done in order to help stimulate economic growth and activity. Businesses can invest more, all that kind of stuff. Theoretically, low interest rates are great, since that means that inflation is under control. Businesses can come get cheap money and it's easier to borrow and all that stuff. Businesses can expand and get more investments, et cetera, et cetera. Isn't that what we've been waiting for, of course, from the U.S. Federal Reserve? Please, Jerome Powell, can't we have lower interest rates now, please? Case in point, of course, the market slump that we've seen recently in the market for crypto and stocks in the USA was attributed to the Fed being speculated to do many fewer rate cuts than previously anticipated in 2025. So how come when it comes to China, it's a bad thing? Well, the difference lies in the context. In the USA, rate cuts tend to be part of a broader economic strategy, but in China, falling interest rates might actually be a signal of deeper economic issues, such as a sluggish economy, a troubled property market, and high debt levels. Now, this, of course, suggests that China's rate cuts are indeed going to be a response to economic distress rather than a proactive measure. Now, adding to these worries, of course, is the growing concern for deflation. But before we break that down, a quick word from today's sponsor. Are you a gamer or developer looking for the next big thing? Then check out today's sponsor, Altura, the perfect mashup of blockchain and AI. Altura empowers developers with easy-to-use tools, and this awesome crypto gaming platform has built the world's first AI toolkit for GameFi developers, taking a step forward to be the market leader in Web3 AI-enhanced games, bridging the gap between gaming
in the artificial intelligence world. It has an AI generation tool wherein developers and gamers can design assets with just one click. It also has a groundbreaking NPC engine that brings non-playable characters to life by giving developers the power to craft NPCs that actually think. And the NPC Engine Plus also gives them memories, which allows for even more unique relationship building with those NPCs. Say goodbye to the boring canned responses and robotic NPCs that we've literally made memes about. All of this can be played in a game world that is easily designed and easily modified using Altura's game engine. And there is more. Altura's Play Wallet is your all-in-one gaming wallet. It integrates effortlessly right across Xbox, PlayStation, PC, and mobile, allowing you to manage your assets on the fly without ever hitting pause. How convenient is that? Aside from the tech, Altura also ticks a lot of other big boxes for crypto enthusiasts. The ALU token has a strong community ownership, no whales, no VCs controlling supply. It has even collaborated with top gaming industry players like Unity, Immutable X, and over 250 Web3 games. Learn more about the future of blockchain right now. Click on the link down below, and thank you for supporting our sponsors.
Okay, back into this. So China's consumer price index rose by only 0.1% in December, marking the lowest level in 9 months and sparking some pretty valid concerns. Deflation is the exact opposite of inflation. The prices of goods and services fall in that scenario. While this might seem beneficial, after all, everything's cheaper. Shouldn't that be great? This can actually cause some pretty significant problems in an economy. For instance, if consumers believe that products like a new refrigerator or any other kind of appliance, or maybe a car, is going to become much cheaper because things are deflating, they might delay their purchases. Less economic activity. Now, this hesitation affects the bottom line of companies, thus reducing their spending and their investment. As a result, economic growth in that situation stagnates, and unemployment rates can rise because companies aren't selling as many refrigerators, so they don't need as many people to make the refrigerators, right? As you can imagine, that situation can spiral out of control pretty quickly. Now, experts believe that an inflation of around 2% is the sweet spot. It's what the US Fed targets, by the way, and when it's slightly above, everybody's freaking out. 2%, perfect. There are also persistent worries, of course, about the Chinese property sector. We've talked a lot about this here on the channel. Do you remember the Evergrande saga? Evergrande's going to go down and take the global economy with it. Well, the Chinese real estate company was one of the largest real estate development companies in the world, not just in China. The company showed a lot of signs of distress in 2021 and finally filed for bankruptcy in 2023. Now, the property sector, of course, is a major driver of economic growth in any country, and in China it went absolutely insane. I'm sure you've seen the ghost cities and stuff of China. People went absolutely nuts on investing in property. And the collapse of what was once the second largest Chinese real estate company, not great. From 2010 to 2020, the proportion of Chinese adults aged 25 to 34 who own homes has actually decreased from 70% to 50%. No wonder the property sector is in a bit of trouble. Now, looking at the job sector, the overall urban unemployment in China is pretty steady at around 5%, which is good. It's good, pretty low, relatively. What is concerning, though, is that the 18.8% youth unemployment rate, meaning young people are having a harder time finding jobs, that was registered in August of last year. So if that trend continues, who's going to buy the properties? Is this a chicken and egg kind of situation here? Young people don't have jobs, can't afford to buy properties. No one's going to buy the properties as people are retiring and selling off the properties. The property sector, of course, is a major economic backbone, and it creates a lot of jobs. Needs new buyers to keep it afloat. When with longer-term demographics in China trending downwards for a population decrease, it creates even more problems. Some even saying it's over for China. They're going to enter the Japan phase, which is a stage of stagnation. But what if the new buyers are scared because of concerns regarding employment and stuff like that? Well, China's rapid industrialization made it the world's factory. Great. They make fast, they make cheap, and they started making not cheap and better, right? And the market ended up getting flooded with stuff like cheap EVs from China and cheap electronics from China, all that kind of stuff. But other countries are fighting back with tariffs to protect their domestic industries, and even some of the industries have moved to even cheaper destinations as Chinese labor costs have increased over time. And we see trade imbalances that heavily favor the the Asian country starting to be renegotiate a little bit. For example, the USA and Canada are imposing 100% tariffs on Chinese electric vehicles because they just can't compete with those cheap Chinese cars. This means it would make Chinese tech products a lot less competitive, and that would trickle down to the country's economy as people buy more American cars and less Chinese cars, for example. Okay, so look, you have the thesis that China's economy is facing a lot of distress. Is it going to blow up in all of our faces and we're all going to be having some kind of new carry trade style unwind or something? Don't know. I think it's probably a bit overblown. China's stimulating is probably going to be okay. But how about you as a cryptocurrency investor? Well, there's the optimistic view and the pessimistic view. Of course, the Chinese government is not taking all this stuff sitting down. We've laid out the problems. What's China going to do about it? Well, China's printing money. A lot of money. China is planning to issue about $411 billion in special treasury bonds in 2025. They've done a whole bunch of other stimulus packages over the last 6 months, literally hundreds of billions of dollars. Now, the funds raised from those treasury bond sales can be used for projects and services and infrastructure and creating jobs and stimulating the economy. And then just this week, we had another big story where the Chinese government splashed another $130 billion into the repo markets, the second biggest cash injection into the repo markets in history. They keep pouring money on the problem. At some point, that's probably going to work and things will kick off and there'll be enough gasoline poured on the spark plug, so to speak, to get a spark going. The market will turn over, things will go. Now, the spending, of course, will inject more money into the economy, therefore creating more jobs, encouraging more spending, etc., etc. Now, more money, of course, will end up creating a bit of a positive feedback loop for China, okay? More people get more jobs, they go out and spend more, drive prices up, etc., etc. All, of course, which could end up encouraging more investing. And that may, in turn, trickle down to, well, potentially the cryptocurrency markets. Now, look, if we take everything at its face value, then everything should be dandy. But as in everything finance-related, nothing really goes quite as planned. So for one, the Chinese central bank has actually halted buying government bonds. This decision was made in order to slow down the heavy trading activity that was putting a lot of downward pressure on the Chinese yuan. There's so many moving pieces in any economy. It's absolutely nuts. Anyway, this is good and bad at the same time. You see, it's good since in theory, this would actually help to stabilize the Chinese currency and prevent bond yields in China from falling too fast. Although bond yields are currently plummeting pretty dramatically, which is freaking some people out and say, big trouble in China, guys. What they're trying to do is not really going to plan. Anyway, might also limit the immediate liquidity in the market, thus slowing down the impact of the stimulus that they're actually trying to pull off in the first place. So how does that affect cryptocurrencies? Well, if the Chinese economy goes on a major free fall, that would probably be bad for everybody for a large variety of reasons. Remember, it's the second biggest economy in the world. And it wouldn't be super awesome for crypto because while you as an English speaker may not realize this, China's markets for crypto are absolutely insane. It's estimated there are 59 million people in China who are invested in cryptocurrencies. And that's a 2023 number, which means that in 2025 is probably even bigger, okay? It's pretty hard to get exact numbers out of China. Some people are hiding their holdings from the government because of the regulatory challenges in the country. But the Chinese cryptocurrency market recorded an estimated $86.4 billion in raw transaction volume between July 2022 and June 2023. Again, these numbers are probably much bigger than are actually being reported. We don't have a great eye into what's really going on in China because officially the government doesn't really like crypto and it's harder for people and exchanges and everything to operate there. Oh, there's a big crypto industry in China. Don't get me wrong. It's just not super out in the open. Now look, when times get hard, people do shy away from risk assets like Bitcoin and cryptocurrencies. Traditionally, investors run to lower risk assets like cash, maybe even gold in this scenario. There's been a lot of gold buying in China. If you think this will only affect China if there's further economic difficulties and the government is not able to bail out the economy, then think again. Because guess what? Guess who let us out of the global liquidity slump in late 2022? China. A lot of countries also, for example, depend on tourism to bolster their economy. And guess what? A weakening Chinese economy and a weakening Chinese currency also translates into fewer Chinese tourists, which means less money for France and Italy and places like this that depend on Chinese tourist money. China also imports about $2.5 trillion worth of goods from other countries, French wine, Italian designer goods, all that kind of stuff. So a weak Chinese economy, again, it affects almost everybody. Second biggest economy in the world. Again, big deal, right? It will affect other economies, and when this happens, people will again run away from crypto and hold on to cash. What's the play here? Well, really, my approach hasn't really changed. I still think that the cryptocurrency markets are primed for some pretty exciting stuff to happen. I always work on the assumption that the bull market's not going to be forever. Nasty bear market is absolutely inevitable. When, how soon, that's a different question, but it's coming, okay? They always come, every time. That's the reason why I have my portfolios in Bitcoin. I have no intention of selling that Bitcoin. Fine. The altcoins, they're all going to get chopped at some point. Okay, I expect my Bitcoin stash for many cycles to come, not in selling it till it's $1 million. What I'm more concerned about, though, of course, is the altcoins. That's why I regularly take profits on them, okay? Now, look, I could be wrong, but I believe that the cryptocurrency markets still have a lot of fuel left in the tank, okay? It's all going to go to hell at some point, but that's for later us to worry about. Between now and then, we've got a lot of exciting stuff to happen. Now, I'm still thinking that we could see a local top in March or April. Seasonality would dictate that that's a likely scenario. Generally bullish conditions in the market for the rest of 2025 based on a weakening US dollar and stuff like that. Fantastic. And you know what the big driver of crypto is going to be in 2025? It's not going to be China, although Chinese economic woes do remain a concern, but it's all about America, baby. America's back. Trump's back. The Fed's going to be forced to do some kind of QE. Trump's going to weaken the dollar, which is going to be great for risk assets. Fed's going to lower interest rates at least a couple times. And so while China is important, I think we should be keeping an eye on it. I think for now, China's economic dysfunction is actually, ironically, a net positive for cryptocurrency markets as the PBOC keeps smashing literally hundreds of billions of dollars at a time of liquidity into the system, which is the rising boat which will lift all boats. And as long as those liquidity injections keep working, we're Gucci, baby. If they stop working and all this other stuff that we talked about in the video will come back to bite us in the butt. But that's for later us to worry about. Right now, good vibes. US gonna pump our coins. It's gonna be great. Thanks for watching.